Hi viewers and my dear friends, as we started already accounting principles. In that, accounting concepts, accounting principles are divided into two categories. One is accounting concepts, another one is accounting conventions. Now, today in this class, we discuss accounting conventions. Accounting conventions, first we have to know what is conventions. Conventions are those traditions and some of the formalities, customs. A businessman has to follow some of the traditions and formalities and customs which are uniform for accounting method. Those are called accounting conventions. Kohler has given a definition about the accounting conventions. Whatever the formality a businessman or a business is following should be uniform. And the accounting method should be uniform. So these are not a conditions, these are not an assumptions, but certain formalities. So these formalities must be followed to get true and fair accounting information and financial information. So the accounting conventions divided into four categories. One is convention of disclosure. Second one is convention of materiality. Third one is convention of consistency. Fourth one is convention of conservatism. Okay, now we discuss these are the four types of conventions are there. For CEC level in intermediate first year, out of the four, any one of the types can be asked for 2 marks question, very short question. So in that, it may be asked disclosure or materiality or consistency or conservatism. So now we discuss one by one very clearly. Okay. So these are very important for what is the use of these while making problems. Here is you have to know these conventions, these traditions. While we are preparing accounting accounts of a particular financial institution or particular business organization for all years, for the particular financial period, these traditions, these customs followed uniformly. We should not change or we should not adapt to the other methods. Okay now? So now first one go for convention of disclosure. Disclosure, the meaning of disclosing means here exposing. What is the convention of disclosure? This disclosure convention followed true and fair law. So businessman and accountant while preparing financial statements like trading account and profit and loss account and balance sheet, embodying the information which is true and which is real. All the necessary information, all which is the information which is related to the financial statements must be shown. This convention of disclosure is a convention and it is one of the accounting principle that uniform method must be disclosed here. That is disclosing. True and fair information must be disclosed here. That is very important. Why? Because of that true and fair information must be needed to the users like creditors or like government or like a banker. Suppose while preparing accounts of a particular businessman in his business, he showed a false statement. Suppose he showed untrue information, then the users get confusion. Means nothing but deceiving only. Okay now? Now come to the second convention is convention of materiality. What is the meaning of materiality? The Kohler has given a definition about the materiality. The materiality, in that materiality what is, while preparing any financial statements like trading, profit and loss and balance sheet statements, these attaching some useful information which is significant, which is needed and which is compulsory. So that is called the meaning of materiality. Means what is, while preparing all the financial statement, we should attach the needy information. We should attach the significant information, that is called materiality meaning. So what the convention says here about regarding materiality? While recording the transactions or while preparing the financial statements, we must use information which is significant. Necessary information only recorded. Unnecessary information, the transaction which has not done and the transaction is going to be done in the future, should not be recorded now. So that is the convention of materiality. Okay now? And now come to the convention of consistency. The third convention, consistency. Here the meaning implies consistency. Consistency means here what? Stability or stable. While according to this convention, any particular business or a particular accounting method which we are following, it should be uniform for year to year, or for the nature of business to other nature of business. Should not be vary with the accounting method from one year to another year. Why here? Because of the convention, it is a formality. In a year we followed one certain method, and in the last year suppose we followed a certain method, and in this year we are following another method suppose, then the user get confusion. Transaction will become different, and true and fair profit and loss we cannot obtain. So it is necessary that while following the accounting method, any one of the accounting method, that must be stable only, consist only, then the businessman get a true profit or a true financial position. For example, I will tell you, generally while preparing under accounts, there will be assets, and businessman adopt to depreciate the assets, businessman adopt some methods. What is depreciation? What are the methods? We discuss very clearly. So one is straight line method, another second one is diminishing balance method. These are the two methods are there, important methods are there to find out or to calculate the depreciation. But the one businessman did what here? In the last year he followed straight line method for particular asset, and in the current financial year he followed DBM method, that is diminishing balance method. Then true information, the furniture balance or the asset balance we cannot get true. If both methods are followed and methods are changed, that is become inconsistency. So consistency is very important. Now understanding here, stability here, accounting method, accounting techniques must be followed uniform and stable. And now come to the convention of conservatism. This is the last one, and last convention, accounting convention. According to this accounting convention, the conservatism says what here? The principle of prudence and prediction about anticipate of the losses but not anticipate of the profits. This conservatism convention explains us about the future. Okay, expect, imagine about the future. But don't imagine profit about the future. Imagine if there is any losses in the future. Anticipate of losses, anticipated losses. Here, this conservatism convention is applied. For example, I will tell you. A businessman sold goods to 100 customers. Then, after selling or while selling on credit basis, he sold goods to 100 customers on credit basis. Then here what will happen? Out of the 100 customers, it is not necessary that 100 customers can repay the money. Any 2 or 3 customers unpay the amount in the future. Now they promise to pay the amount, but they will unpay the amount in the future. So now the anticipation of the how many customers are will become bad. Means bad debt. Debt means here which is recoverable amount in the future. Now it will become what here? bad. Now only we should what? Expect. Anticipated profits cannot be expected, but anticipated losses can be expected. It means in this financial year we got a profit of certain, after selling the certain commodities we got profit of 10,000. We cannot expect about the future we get 20,000 or 30,000 profits, anticipated profits, because of the getting profit depend upon the price determination of the particular product in the particular time. So anticipated losses, future losses can be imagined. That is the account convention of conservatism. Okay, now? So these are the 4 conventions we discussed very clearly, and in the next class we go for some other more topics which are very interested. Okay, thank you very much.